Good Wednesday morning, Market Chameleons and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dimitri Pargamotic, who actually looks a lot like me in that picture. How you doing, Dima?
Hey, Will, how's it going? Do I have
I've had better days for sure. I was under the weather yesterday. Today I'm further under the weather.
Oh,
I
yeah.
don't know. It's in my chest, in my my sinuses. I've got a fever. It's not going so well. But we'll get through the show. Anything for the show? You want to start with a disclaimer?
Tea and lemon.
I'm going to get some tea and lemon. Maybe some whiskey too.
Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Excellent.
And let me share my screen. If anyone is joining for the first time today, we do this show every morning to help answer questions you may have about the Market Chameleon tools, data, analytics. If you want to come on a show and ask a question about perhaps a strategy or something unusual you've seen, we put out a link to Zoom. And if you click on that link, it takes you over to Zoom. I think that link is on the live chat on YouTube. Once you get into Zoom, there's a button at the bottom. It says raise your hand. Click on that. You don't have to turn on your video camera. Once we admit you in, everyone could hear you, but then you could ask your question live and direct. If you prefer to ask a question by typing it in, you could also put that into the live chat on YouTube. Will's watching it. He'll read it back to me. What we'll do is, while we're waiting for questions to come in, we'll take some time. Let's take a look at the pre-market report. What this will do is look at stocks that are trading in the pre-market hours and see if we can get some insights there. If questions come in, you'll stop me, let me know. We'll get to those. If we don't have questions come in, I'll just continue on looking at other insights on the website, or I'll default to some questions that I get over, either the emails or chatting with people, and I'll try to cover those. Okay, so let's start out with the pre-market report, and then get to the questions. And this is the pre-market report, and it's a list of stocks that are trading in the pre-market hours. We have a list of our most active stocks, our biggest percentage gainers, biggest percentage decliners. Down here, I see 49 stocks that made our percentage gainers list, 38 on the decliners. So from this perspective, we're looking like a more bullish bias at the open. But if you look at this list, there are stocks in there that are low cap stocks. There are ETFs, leverage products, closed ends, preferreds, anything that's listed on the major U.S. exchanges. If it's trading in the pre-market hours and meets our thresholds, it can make this list. So we want to narrow down this list to a smaller group of stocks to get a little bit more focused insights. What we'll do is filter this list down to S&P 500 companies, and let's see what's going on there. And to do that, we've got to use the filters here above. I'm going to use this filter in ETF. I'm going to click on it, drop it down, and we get a list of ETFs to choose from. You can see some of it are sector specific, industry specific, and then we got the broad-based ones. So SPY broad-based ETF right here. Let's select that. And you can see that this filtered down the list to S&P 500 companies, this is Dow Jones here, SPY. This filtered the list by stocks that are holdings in SPY, which are the S&P 500 constituents. And here, 4 stocks made our percentage gainers list, 4 in the decliners. Again, it has to meet certain threshold to be considered gainer or decliner, so it needs to move by a certain amount with this. And this just shows us that it's pretty even. right? Not much going on. Yesterday, we had, I think, what, 1.5% were down after Powell was talking and kind of gave an indication that we might have to be more, we downshifted in interest rates, but we might have to go back and do an upshift and raise interest rates a little bit more aggressively to tame that inflation. We've been talking about inflation and all the constraints and maybe the limitations that the Fed has. So this might be, a bumpy battle, just like he said. It could be, I forget the words he used, but something like it could be very bumpy to tame inflation, bring it down to their target level of 2%. So let me see. Let me know, Will, if you have any questions. If not, I might just start, navigating to different parts of the website.
Yeah, no questions have popped up yet, D.
Okay. Let me think. I'm trying to think back to some questions that I get in the emails. So one, interesting, I think, questions that come up have to do with, what. So why do we want to look at like order flow and what's going on, in the markets, and let's talk about that for a second. Maybe I'll use like Tesla as an example. And when the question was something like, well, really doesn't matter if we look at, order flow and who's doing what. The price is the price, and let's just look at the math, right? Just look at the math, and that's it, and follow the probabilities, follow the statistics, and everything else doesn't matter. Something like that, right? It doesn't matter how the stock got here, it's here, or who did what. It doesn't matter, like, who holds positions. Just follow the statistics. And since the beginning of time, since trading, it did always matter who's holding what and what are people's positions. Think of it this way. If you were playing a game of poker, right, and you were able to see whatever, if you're playing against 10 people, and if you could see what they're holding, what is their position, that's a big advantage. Might not guarantee you'll win because you still have uncertainties and things, but it's a big advantage knowing who's doing what. And I'll give you an example that are probably highly publicized, right? That you guys should know about. So one is in a Big Short, right? Where the Big Short was where before the financial crisis started, right? Before Michael Burry, he was doing the analysis, and he said, okay, the housing market's going up, the mortgages are going up. Statistics say that housing prices don't drop. More people pay their mortgages. And those were the stats. And by the way, those were the stats that the big banks were following. Those were the stats the Federal Reserve was following. Those were the stats, FHA, everybody was following those stats. And what he did was say, okay, let me just take a look at what's going on and who's doing what, right? And he said, well, number one, who's buying these houses? Well, a lot of these mortgages were made to people who were, what do you call it? Homeowner occupied, or what do you call those people? Well, people who were buying houses, taking out traditional loans, but they weren't owner occupied. They were basically done to rent them out or to speculate on them. The other thing is, a lot of these mortgages were made to people who couldn't even afford it. They were doing it with no doc. They also had people were taking out mortgages with the lowest interest rate, which had the highest risk of resetting. And who was holding the other side? banks and institutions. And why? Because they were being insured by AIG and Bear Stearns or whatever, and then they were getting AAA ratings. So he mapped it all out and said, okay, now I know who's doing what. I know who's holding these positions. I know who's on the other side of these positions. I know now the risk, and it does not make sense to me because why? Because, the people who are taking out the mortgage, you could look at the stats historically, but something's changed. These aren't your traditional home buyers. These aren't people who can afford it. These are terms that are not realistic, and these are risks that are not being considered in the market. And he could even time like when the mortgages would start to reset, which would trigger higher payments where people can start potentially to default. And he said, well, who's holding these positions? Banks, who's selling these credit default swaps? The banks that the credit default swap, they're not priced. They have too many of these credit default swaps. They didn't price it correctly, and he took the other side. And of course, then it all kind of blew up. But that's because he knew who was doing what. If you just followed the stats, it all looked normal. It looked normal to the big banks. It looked normal to the Federal Reserve. It looked normal to the ratings agencies. It looked normal to everybody in the world, except for a few people who just decided to look at what's going on. I'll give you another example. You guys know it's more recent. FTX. FTX is it's the crypto exchange that blew up, right? So FTX had a position on, but people didn't really know about it. And what they were doing was using their FTX tokens as collateral to borrow money. Okay. Nobody really knew that, but that's what was happening in the background. So what was happening is that they had this position. Nobody knew about it. Everything was trading normally, but they were highly leveraged based on using their tokens as this collateral. So what was happening is what they were in danger of is if the FTX token dropped below a certain price, that triggers a default event where they have to start selling it to pay back the loan, right? Automatically, they have to start selling it to start paying back the loan because your collateral is now gone below the price, where it triggers a default, a sell-off in your assets. So nobody knew that. And then there was a spat between them and the other exchange. And he said, that he wants to sell his tokens. Was it the Binance, what's his name? Well, the guy from Binance. And one thing, but hello? Will's on mute, so
yeah, sorry about that. I've been sneezing. I forget the Binance CEO's name, but I can figure it out real quick.
Yeah. So what happened was the CEO of this Amada, who was holding this position, tweeted out in response to him, well, we'll buy your tokens. And now people started to realize that they were borrowing against these tokens. That started to come out. But nobody knew exactly how much they borrowed and, where would it be triggered. So what happened was that the CEO said, hey, I will buy your tokens for whatever it is, $25 a token. All of a sudden, the markets figured out what the position was, that they needed to hold the price. That was the trigger price, 25. If it falls below that, that is where that's where the stop losses. That's it. They no longer can hold on to that loan. They have to start selling their collateral to pay back the principal. So once she said that, people knew the position. and they wanted to get out because they thought, okay, I'm not going to hold it here because once it goes below that price, that's it. That this token, whatever they're borrowing, they got to sell, and they're going to be out and potentially out of business because they're putting up their own token as collateral. But that was, people who understand who's doing what, what's influencing what is just as important as any fundamental or technical analysis or statistical analysis. And when we look at the markets, right? Well, we want to know, okay, there's 141 million shares traded in Tesla, but where's that volume coming from? Like who's doing what, who's holding what positions, where is it coming from? You try to dissect it to understand it. Okay. And by the way, doesn't matter, your trading firms, big banks, they're always trying to understand who's holding what positions and what those positions must be anticipating. So where does order flow come from? We know that it comes, there's money flowing in from pension funds, retirement accounts, and those are mostly non-fundamental, right? People put money into things, are taken out of their checks, and then those are passively invested for them. There's also money flowing into ETFs. There are stock buybacks from the companies, so those are also basically passive money coming in. Meta decides we're buying back, whatever it is, $10 billion worth of shares. They give it to a broker chops it up, and there'll be $10 billion is going to flow into the stock over the course of a quarter. So these are money flows that we could kind of map out and anticipate. There's mutual funds, but then those are passive, right? And like, for example, here, let's take a look at Tesla. So if we took Tesla, and here inflows, inflows, outflows in Tesla, what is this, by month? I believe this is the last one, but by month. So you could see that, month to month, I don't know, there might be, a couple million shares going in and out. Let me see if I have daily. Should put up daily here. So look, about 10.4% of the stock shares outstanding is owned in ETFs. And that's important because that's pretty stable. That's not going to, we can measure it over time, but that's not moving around like crazy, right? So that's pretty stable. We could kind of measure on a daily basis how much of this is going to be influenced by the ETFs. But then there are active traders. There are active traders, and let's say we divide them up into technical, fundamental traders, and then some of them are trading in the option space, right? So there is a way to kind of measure, how much of the volume might be from technical and how much of the volume might be from fundamental, but I'm going to kind of just focus on this one, on the options order center. And what this is trying to do is say, okay, we have 141 million shares traded yesterday. The stock moved down. So how much of this 141 million shares do we think we could explain, is coming potentially from the options market? Because the options market are, on Tesla, the underlying is Tesla, and options create delta pressure one way or the other. So we could kind of measure the delta of the trade and accumulate it, and then say, if this delta, was hedged, how much of it do we think potentially can be explained of this volume is coming from the options market? Now, some stocks, the options volume is negligent, and most of that stock volume, is due to other reasons other than the options market. But here, if we take a look at Tesla, if we just looked at the order flow coming in, we estimate that about 23.5 million of deltas came in positive, 24 million were negative. But if we just summed them all up and said what percentage of these deltas make up the total volume, it's about 33.8%. So it's a significant, in other words, there's a significant amount of volume potentially coming from the options market that could impact the underlying, right? And that's it's not looking at existing positions that might be rehedged, because that would increase that. That's looking at just the volume coming in on the day. So that's why if it's a big amount, you want to kind of pay attention. Well, what are they doing? Because that is one segment of the order flow, one trader type, one cohort that can impact, what's going on in the stock price, right? And we see that, look, on balance, we think that there was a negative 800,000 deltas. So basically more bearish pressure than buying pressure. But on balance, that's not a significant amount, given that there's a lot of trades going on. So that wouldn't be a significant amount on balance. But if we look at the day's volume, there is a lot of volume, enough to kind of pay attention to what do we think is going on, because it represents a big portion of the potential volume we see in the underlying. Okay, so that's one of the things, just to try to explain some of this away. Why are we looking at this? Well, first we want to isolate, how significant are the option trades relative to what we see totally trading in that stock. And if it's significant, then you really need to pay attention there, what's going on, right? Because then we could kind of explain away. But that's one of the things, so that was why, the questions come in. Well, why is it important to look at order flow and positioning, right? Well, it's not the stocks themselves, right? The stocks themselves, yes, they're fundamental traders, right? They're technical traders, they're pension funds, they're mutual funds. They all have, their own methodology of investing and holding stock, and for the most part, pensions and IRAs, they'll be more stable. They're not, trading in and out, right? Technical analysis, fundamental analysis, fundamental traders, let's put it this way, fundamental traders also usually don't trade as much as technical analysis, because they need some kind of fundamental number to change their forecast and opinion, right? Like earnings, you could kind of map out, well, here's an increase in volume, there's an earnings event, there are more numbers coming out. That's when the fundamental traders, you'll see them the most active, because that will impact their pricing model, right? Once you change earnings estimates, your future outlook, all this right around earnings, you see the fundamental trader being the most active, because now they have variables and inputs that are changing inside their model. Same thing around GDP, inflation, you're going to see an uptick in volume, because those fundamental traders using those models, something happened, they're changing their input, and they're going to reprice the stock accordingly. So you're going to see an uptick in volume from the fundamental traders during that time. Technical, that's more of like, when things trend and hit certain, there's so many different technical traders, but usually it's based on stock movement that's not repricing quickly on a fundamental basis, right? Because that technical analysis doesn't take into consideration fundamental numbers. They just look at, trends and breakouts and stuff like that. So you have the passive traders, the active traders, and some of the biggest active traders in some places are going to be the options traders. So let's take a look at here. Let's see something like Microsoft. So Microsoft, about 40% of the delta volume, can be explained for the trades total in the underlying, but I'm sure give me a stock that's, let's say, Wayfair. Let's see how that is. So a little bit less, 28%. So that's what you're trying to do, is map out who's doing what kind of positions they might be holding, because that builds you a bigger picture of, where the flows could come in that could, influence the future demand or supply of stock.
That was awesome, Dima. Thanks so much, my friend. Everyone, remember to subscribe and give us a thumbs up. It's always appreciated. I really do appreciate when people call up the thumbs. Really helps. Great job, buddy.
All right, everyone. Thanks for joining. Stay safe out there. Have a great trading